Welcome to Economic Confidence, the Chain of Mutual Gain. My name is Dean. People ask me about the economy a great deal because they know that I speak with many business owners, commercial property owners, and investors. I graduated from college with my degree in real estate banking and finance. During my college years, I ran my own commercial real estate market research company. And from the year 2000, I have been in commercial real estate consulting, sales, and leasing. The questions I get about the economy and the state of the commercial real estate markets do not stop. I get the questions on weekends, special events, parties, restaurants, weddings, and the list goes on and on. When will the economy improve? When will our qualities of life improve? When will the credit markets improve? When will education improve? People have a lot invested in their goals, ambitions, and plans. How do we maximize occupations, businesses, innovation, confidence, and foresight? Businesses use commercial real estate, and people have a vested interest in financial and economic answers. This caused me to do much research for the last 3 years into the answers of the question, what really drives the economy, and the possible solutions we can reach in the markets. The research became a mission to provide the public with reasonable, real, and relevant solutions to economic questions. The most staggering thing I remember in economics class was that the behaviors and actions of the individual participants in the market influence the economy. Consumer confidence is the belief that the participants in commerce have about the direction of the economy that steers its course. One of my goals is to identify the areas of entrepreneurial confidence, or confidence among the business community. Economic confidence, the chain of mutual gain, is about adhering to the principles that propel us as individuals, as the decision-makers within households and businesses, to progress. This study includes real estate, philosophy, anthropology, a bit of psychology, and history to derive rational conclusions. Economic confidence involves defining your life and focusing on what's right, and coming back stronger than you ever have before. The result of this program is that you will have an integrated plan for your future as you perform the recommended assignments. I can get you started, and it's you that will write the chapters on applying confidence, wisdom, and encouragement to your individual endeavors. We discuss the original meaning and origins of words in this seminar because we want to get to the root of solutions and answers. You may find that we look at and explore definitions from over 2,500 years ago to establish a type of philosophy. When we discuss philosophy, understand that I want to share with you knowledge that you can combine with your experiences with wisdom that you can apply. At first, I wanted to call this program Economic Faith or Economic Trust. Faith is defined as confidence or trust in a person, concept, or thing. It just made sense to me to use the terms confidence, faith, and trust interchangeably. Concerned friends and professionals told me that faith involves too much of a connotation or a reference to a belief system. The point that I need to make is that capitalism is a belief system. Capitalism is an applied ideology. It is a belief system on how business and commerce should operate. And the root authors, the logical discoverers of capitalism, provided a code of conduct about how businesses should operate. And it is within this application of the code of conduct of capitalism that we discover the chain of mutual gain. Economic confidence, the chain of mutual gain, involves maintaining great expectations based on adhering to and following the core economic principles of capitalism. It involves ambitions, transformations, actions, creating valuable ideas, implementing them, and gaining higher qualities of life. Economic confidence involves a conscientious assessment of the way things are, in order to influence a greater future. If we can adhere to the basic principles, we have a powerful catalyst for economic growth. Consider the chain of mutual gain as a diagnostic check for your career, vocation, or business, so you can run your career on all 6 cylinders. This series is submitted to you as a guide to restoring and reinforcing the ideas that help us to succeed. We must move in positive directions with written ambitions on our minds. Since you have purchased this program, I would ask you to join me in making greater and broader economic success a common goal. The word economics has its origins in ancient Greece. Economics comes from the word oikonomia, which defined is management of a household, from oikos meaning house and nomos meaning custom or law, which leads to rules of the household. Schools would have classes in home economics. The word slowly evolved to mean the administration of a business, or business economics. The origins of economics as a civic science began in 1776, and we will go into more detail about this in Chapter 2. Together, let's make this a common goal, that we build value in the areas we control. We are concerned with the confident administration of businesses as the key to growth. Let us build our confidence and continue to gain knowledge by sharing opportunities and building success in the future based on implementing economic wisdom. You hinder your goals when you allow your fear to grow bigger than your courage. And I have met a lot of people who react to their economic situation. We will build on concepts of economic wisdom and economic courage to give you the advantage to respond to your economic situations with applied foreknowledge. I watched refresher business and economics courses online. I reread my books from college written by economics professors. I'm going back to my notes from macroeconomics from my teacher Don McDowell from Florida State College at Jacksonville, Florida. I looked for parallel knowledge among the other materials I most recently read. Some of my notes say, the direction of an economy is a self-fulfilling prophecy. When people expect the economy to improve or decline, they behave in such a way that brings the desired outcome they anticipate. I was in awe at the way economics was compared with predicting the future. I was breaking down the sentences. Expect, improve, take actions, desired outcome, anticipation. Expectations over the way buyers will behave, expectations the banks have for the people they intelligently loan to. Expectations always involve the future. I could easily compare these notes to the books and video Age of Uncertainty from economics professor John Kenneth Galbraith of Harvard University. He compared economists to prophets based on their ability to predict movements of economies. He also referred to capitalism as a belief system. After I graduated from college, I drove to an office supply store to purchase a safe for business and investment. I was collecting coins, gold, silver, storing stock certificates, and protecting my travel passport. There was my economics teacher, Professor McDowell, in the store as I was walking toward the aisle where they kept the combination safes for companies. We talked about business goals after graduation. I talked about my ambitions for real estate and let him know I enjoyed his class. As I started loading the cart, he asked me, "Why are you buying a safe?" I said, "You taught me that economics is a self-fulfilling prophecy. I'm expecting greater wealth in my personal economy. I am showing my consumer confidence because I expect to have items of value to put into it. The gold is now sold and my business safe now contains my passport, social security card, and deeds to the properties I purchased during the last real estate boom." The collective economic faith or economic confidence of the individuals and businesses is stronger in growth periods of the economy. This is a fact. I learned about the business cycle. It was right there in my notes. I was taught that it existed, and the responsibility for being blindsided by the twists and turns is a lesson that I learned. Now we need to conscientiously navigate the next cycle, so the booms and busts, expansions and contractions of the economy will work in our favor. The business cycle. A business cycle is the periods of growth and decline, booms and busts, expansion and contraction in an economy. There are 4 stages in the business cycle, and these stages are constantly repeating over a number of years. 1. The contraction, when the economy starts slowing down. Contraction is characterized by credit tightening. Banks decrease their number of loans. Mortgage lenders want higher down payments on homes. Regulations increase. The trough, when the economy hits the bottom. The participants in the economy are not sure they have reached it until they have passed it. The trough is the point at the end of the recession. Both the contraction and the recovery are times of preparation and of education. It is important during the contraction and the trough you maintain this mindset. The longer the delay, the more I make it pay. Write this concept down. You must face this period with determination. Expansion. When the economy starts growing, it is characterized by confident expectations, credit expansion, wealth creation, and bank deposits increase. The banks feel better about the economy. They start lending to businesses. The intelligent use of credit can flourish during an expansion. Day by day, the economy is getting better in every way. The majority of the negotiations in the economy work together to prosper the economy. 4. Peak. This is the harvest period. It is when the economy reaches its highest state of expansion. The stages of the business cycle are like the agricultural cycle, or the seasons of the year. 1. The contraction is the fall. 2. The trough is the winter. 3. The expansion is the growth period. It's the summer period. The peak is the harvest or the fall. Metaphorically speaking, and in a graphical sense, the business cycle is like a wave that measures the growth stages of the broad economy. The question is, how are we navigating this current wave? Here is an analogy. The largest waves in the ocean are at a place called Cortez Bank. The waves go up to 80 feet or more where they meet a row of mountains beneath the sea. We were used to navigating 6-foot business cycle waves, and now we are forced to navigate a 100-foot-tall business cycle wave and the points of credit contraction that came with it. In order to understand a business wave/ocean wave metaphor, we will discuss liquidity. Liquidity is the ability and speed in which an investment can be converted into cash. Stocks are very liquid because they can be converted to cash easily at the point of the exchange. Millions of shares of stock are bought and sold daily, and the speed and efficiency of the trades have increased. Real estate is not as liquid because the sales process takes a longer time. The average ownership time of a single-family home is 14 years. The amount of time for stock ownership varies greatly, which could be from 1 hour to an indefinite period of time. When long-term investments, homes, were forced into short-term investments, securitized, there were many more buyers than sellers in the marketplace, which influenced the business cycle wave upward. At the time of year when the weather conditions are right, the most experienced surfers in the world go to the Cortez Bank off of the California coast to surf the 80-foot waves. It takes a great deal of conscientious investigation into the right time of year for this area to be safe. Who can stay on their board when the crest is 90 feet? Who can stay on their feet with balance when the wave is overwhelming? No worthy surfer begins standing on 1 foot in 2-foot waves. The surfer must conquer the skills of balance and equilibrium. The principles of balance and equilibrium apply to economics in decisions on pricing. Profits of a corporation or business are maximized at the point where supply equals demand. This is called price equilibrium. In real estate, this is measured by comparative or competitive sales in the marketplace. It's the challenging waves that prove the skills of the best. You learn to navigate your way through the large business cycles through contrarianism. A surfer will paddle out to the wave with his surfboard pointed towards the wave, but at the point where the wave crests, the surfboard is reversed, the surfer stands on the board, and with balance and equilibrium rides the wave to the shore. The contrarian philosophy of the markets is this: when everyone is buying, you sell, and at the trough at the bottom, when everyone is selling, you buy. How do you know when to sell? It is the time where you watch your business TV commentary and everyone is an eternal optimist. It's when you get on the phone and the person on the other line says, "The market is going up and it's never going to stop. And this time, it's different." The time to buy is when the person on the other end of the phone says, "The market is going down and the economy is permanently broken. It's never going to be like it was. Innovation and creativity are over." These are two extremes of thought. Seasonality is a type of contrarian investment. Contrarian shopping is when you buy all your winter clothes during the summer and purchase all your summer clothes during the winter. Rightly discerning and navigating our way to future growth is the challenge, and we will meet that challenge together. George Santayana, a philosopher from Madrid, Spain, said, "Those who cannot remember the past are condemned to repeat it." It was Sir Winston Churchill who said, "The further backward you look, the further forward you see." Let's use these quotes like a map that we will use to study the past, learn from, and apply to the future. This is why we need to investigate bubble theory in history. Economic bubble theory is this: that historically, it takes as much time for the markets to correct out of an economic bubble as it did to get into the bubble, and prices return to the levels to which they started. The first recorded economic forecast in historical literature is the story of an agricultural cycle in the Judeo-Christian Bible. In Genesis 41, Joseph is called by the Pharaoh of Egypt to give an interpretation of a dream. Joseph told the Pharaoh there would be an agricultural cycle of 7 years of prosperity and 7 years of famine. Save 40% of the crops every year in the first 7 years of the agricultural cycle to feed the people through all 14 years. The grains became a type of national equity. This economic advice, based on intuition, saved Egypt, and just like the economic bubble pattern, the time it took to enter the economic bubble is equal to the time it takes to get out of it. Save 40% of your equity. If Joseph was going to use a graph to represent the storage of grain over the 14-year period, he would point it out the window because it would look like a pyramid. Learning from history, the concept of saving 40% of your income per year during the next growth cycle is a wise idea. The Tulip bubble in Holland was a different type of agricultural cycle combined with a free trade market. It emanated from the genetic colorization of tulips in the early 1600s. The newly colorized tulip was rare, sold at auction, and bid to the point where each individual tulip was the same value as a 2-year salary. Luxury houses could be purchased for a bouquet. They were so valuable that people thought mass cultivation would make them billionaires. It took about 2 years of exponential cross-pollination and compounding of seeds to harvest millions of tulips. The supply became abundant and the prices came down. The mass cultivation of tulips in the 1600s permanently impacted the economy of Holland because they have the largest floral distribution network in the world today. The South Sea Company bubble occurred in 1720. International trade was evolving in the early 1700s. Several reports came out exaggerating and boasting about the import and export contracts of the South Sea Company. The stock price of the South Sea Company went up 1,000% in 1 year. When the reports turned out to be exaggerated rumors, the stock lost its value. Sir Isaac Newton, the inventor of calculus, invested and lost £20,000 in the South Sea Company bubble of 1720. He was quoted as saying, "I can measure the stars, but I can't measure the madness of people." The railroad bubble occurred in 1893. A series of banking mistakes occurred in railroad lending. Railroads invested in the real estate where the rail lines run, and the railway network became 17% overbuilt in 1893. The recovery occurred in 1897 after a period of 4 years. During the late 1800s, Henry Flagler, the business partner of John D. Rockefeller, brought a number of railroad lines into Florida, and the eventual result was investment in Florida land, which led to the 1920s Florida land boom. The price of Florida real estate doubled several times over from 1920 to 1925 as the result of too many buyers in the market. Seasonality was a factor in the Florida land boom. There was a great amount of advertising in the Midwest and Northeast United States. During the winter periods, a trip to Florida seemed like paradise, and there were several people who wanted in. One property in Miami sold 10 times in 1 day. The savings and loan crisis of the 80s and 90s is a more recent study of bubbles in lending and property. In 1989, 1/5 of the 3,300 banks in the United States were bankrupt, and many of the remaining banks were riddled with foreclosures. L. William Seidman, former chairman of the FDIC banks, stated, "The banking problems of the 80s and 90s came primarily, but not exclusively, from unsound real estate lending. Banks loaned more money than was manageable. The Resolution Trust Corporation was formed by the U.S. government in 1989 to sell the assets of the savings and loan banks. Properties were being sold for 50 to 70% of their original value. Some office buildings sold for 20% of their value in the early 90s by the remaining banks that were required to sell their foreclosed properties." Due to my work in real estate research, I have access to past real estate sales data. Owners of property who bought in 1995 and sold in 2007 made from 78 to 480% on their initial investments during this 12-year period. Investors who leased their properties to tenants made an average additional 10% higher rate of return on their money every year. The investors that buy properties from 2007 to 2016 will receive greater returns during the next real estate peak. The goal, the ambition, the purpose, the motive, the secret to all business and investment is to buy low and sell high. Revenues minus expenses equals net income. It was my first day of class in accounting. My professor, Noel McKeon, repeated this equation in several different ways the first day. Total revenues minus total expenses equals net profit. This is the core of the business equation. Great moments and good timing can occur when we correctly navigate the next real estate cycle. In 1971, the Nobel Peace Prize winner for economics was Simon Kuznets. He theorized in 1940 that real estate cycles take about 18 years. This measurement is now referred to as the Kuznets cycle. From the early 1800s, every 18 years, real estate markets maximize volume, pricing, development, and lending. The last peak in real estate pricing and valuation was in 1989, and that is when the peak ended, the contraction started, and then the next peak was 18 years later in 2007. It was noticed that the Rockefellers' real estate investments in the past have fit comfortably within the 18-year rule. Current applied economics professor at the Johns Hopkins University, Steve Hanke, has an article written for the Cato Institute titled The Great 18-Year Real Estate Cycle. Visit www.cato.org to access the article. The 18-year cycle skipped from 1925 to 1973. This was due to the rise of the suburban residential core from the 50s. The 1970s and 80s saw the beginning of the commercial suburban development of office and retail. The market peaked in 1973, peaked again in 1979, based on the high double-digit interest rates of mortgages. The peak from 1973 to 1989 was 16 years. The assets of the S&Ls took 4 years to sell from 1980 to 1994. The markets improve again as the real estate cycle of growth begins for a period of 14 years, the average time of residential home ownership. Further research into the algorithms of the 18-year real estate cycle are discussed in the books of Fred Harrison, British author and economic commentator, who correctly predicted the real estate peak of 2006 and 2007. We must proceed with a sense of due diligence to adhere to the economic principles at the foundation of business. In future chapters, we will explore philosophies of motivation and vocation, designed to reinforce the dynamics of prosperity. Now is the time, and today becomes a day of phenomenal opportunity as we plan for the future.